The Share Pickers Podcast with Justin Waite. Content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the Share Pickers Podcast with me, Justin, and
Fred.
Monty.
They're my sons, by the way, and they are investing in the US markets. Guys, Fred, do you know what stocks you own?
McDonald's, Costco, Tesla, Amazon and Netflix.
We own Amazon, Costco, McDonald's, Microsoft and Tesla, all right? Yeah. So this week, because we missed last month, we try and do one every month, we missed one last month, and I normally give you £20 a month, so this time you got £40 to invest, all right, Monty? Do you know what shares you own?
Berkshire Hathaway, Philip Morris,
Yep.
Starbucks,
Yep.
Apple.
Yep.
I don't know.
You own Apple, Disney, Google, Berkshire Hathaway, Philip Morris and Starbucks. I want you to sell one of those, Mont, okay? Because you've got too many stocks, you're spreading your capital, your money too thinly, okay? So out of those stocks... Now, when you think about selling stocks, right, you've got to think about, are you diversified? Do any of you know what diversified means?
No.
No.
It means, have you spread your money? So you've got to spread your money, quite evenly, but not too much. Now, when I mean diversification, I mean different kind of sectors. For example, what does Apple do, Mont?
Make phones.
Yeah, so they make phones and sell services as well, like cloud stuff. Is there anyone else in your portfolio like that? Disney, what do? They don't do that, do they?
They make they don't make movies, but they're a streaming website.
Yeah, well, they make movies and they're streaming, yes, and they got theme parks, haven't they? So that's not like Apple, so that's good, that's different.
Of course they make movies.
Yeah. So Google, are they similar to Apple?
Not really.
No, they sell advertising and
search engine.
Yeah, search engine. Plus, they've also got cloud. So a lot of people hold their business in the cloud, and that's what they charge for. Berkshire Hathaway. What?
I know which one I want to sell.
Okay, what I'm saying is you should try and find two companies that are very similar and maybe remove one, okay? As yet, Berkshire Hathaway is an investment company in different companies. Philip Morris is tobacco. Starbucks is retail. So you've got quite sector diversified. You've got different businesses, different areas. All right, so have a think. Fred, have a look at yours. Are there any of these similar, do you think? Amazon, Costco, McDonald's, Tesla.
Are you stupid?
No, I did both.
Monty said Costco and McDonald's are similar. Well, they sort of are, aren't they? They're sort of
No, they're not. Are you dizzy?
Why?
Because one sells furniture and TVs and all that, and the other sells fast food. I think Costco and Amazon are quite similar, but Amazon's the better version because it's online and it comes in one day, and it's just easier because you don't have to go out of your home.
Let me amaze you with a fact here, okay? Do you know where Amazon makes most of its profit from?
Well,
Shipping.
Shipping? What do you think, Fred?
Costco.
Amazon makes all its money from Costco?
Yeah.
Oh, I see where you're going there. No, Amazon makes most of its profit from AWS.
What's that?
Exactly. Basically, most businesses don't have their own servers. That means that all their work is not saved on their own computers because it could crash. The computer could crash, so they keep it in the cloud. Amazon have a massive cloud business where a lot of businesses host their own websites on. That's Amazon's most profitable part of the business.
So they don't own it.
Businesses don't own it. They rent Amazon's cloud space because it costs a lot of money. It's like warehouses full of these servers, these computer servers, space basically in the cloud, and that's where Amazon earn most of their money. So it's not really retail, even though it's got a big retail arm. The stuff you get delivered to you, it's not really retail. So anyway, Fred, I'm going to ask you a question here, boys. Okay, we are in a bear market now. Do any of you know what a bear market is? Go on, Mont.
Is it where all the markets are down?
Yeah. Doesn't happen very often, right? So once every 4 or 5 years, you get big sell-offs that happen in the market. Now, a lot of people panic, a lot of people sell their stocks, but it's also a good opportunity for what, Fred?
I wasn't listening.
Buy it!
He wasn't listening. Thanks, Fred. So when the stocks go down, if the business is still doing the same, the company is cheaper. You can buy more shares with less money, okay?
There's a bull market
Yeah, what's a bull market?
where it's really high.
Yeah, it was where bear markets is what's called a 20% drop from its recent highs. So dropped 20% more than that. A bull market where it's rallied 20% from the bottom upwards, okay? Yeah. So it's a good opportunity to invest in good businesses if you think they're going to be around in the long term and do well in the long term. So Fred, I want you to now think of the companies you've got there, right? And I'm going to put £20 in 2 companies, all right? So what are you going to go for? Amazon, Costco, McDonald's, Microsoft...
And Tesla.
I would say, though, let me just say one thing, right? So Costco and McDonald's and Microsoft pay dividends. So it means you don't only get paid when the share price goes up, you also get paid every now and again for owning shares. A little bit of money comes through just for owning shares. So consider that, because over the long term, it's good returns. So what are you going to go for? So Amazon, Costco, McDonald's...
Tesla and...
Why Tesla?
I don't know, it's just good because it's quite new, but it is one, so shut up. And everything's going to be electric cars soon, and Elon Musk is working on that. So, and also for the dividends.
They don't pay dividends.
I know, no, yeah, that's why I'm picking another one.
Okay, yeah.
Stupid. Right, what were the dividends again? And Microsoft, actually.
Microsoft, okay. £20 in Tesla. Yeah, Microsoft pay dividends, yeah, and Tesla pay dividends. So, and also think more. Now, you're going to get rid of one of your companies, right? You've got to think of a company that's going to be strong. Avoid companies that are going to be stronger in the next 10 years. You want companies like Tesla, for example, Fred. You could say there's going to be a lot of competition for Tesla because all the big car companies are also doing EV now. So before,
Tesla was the first one. They're quite like a high brand car.
Yeah, it's true. You get first mover advantage. When a company goes into a new area that's very popular, they get first mover advantage. That means everyone... Because let's be honest, if you went to buy an electric car like 3 years ago, you wouldn't have a lot of choice. It's Tesla. Now, the choices are getting bigger.
You get like an electric BMW,
electric Mercedes, Volkswagen, Ford, anything. So the trouble is, Fred, with Tesla...
car.
Yeah, trouble with Tesla, more people are coming into their space, more people in their market, aren't they?
Yeah, but Elon Musk wanted to fight Putin, so everyone's going to want to buy Teslas because he wanted to fight Putin.
Okay, but let's say you start a t-shirt let's say you start a t-shirt business called Fred's T-shirts, right? And doing very well. People love your t-shirts, right? And you're the only one in the market doing these kind of t-shirts. And then someone else called Monty starts a brand called Monty's T-shirts. And people say, "Oh, Monty's T-shirt's quite good. I was going to buy a Fred T-shirt. Now I'm going to buy a Monty T-shirt."
Yeah,
I'll strangle him to death.
Yeah, you can't do that if you're Fred off. You can't do that if you're Tesla and Ford, and you can't just say go around and strangle the Mercedes boss to death. Doesn't work like that. So you sure you want to put in Tesla, yeah?
I will make new inventions, like more cars, like more. I will make new inventions and like more cars that like are just better and like do more stuff.
Okay, so you don't believe Tesla is going to lose a big chunk of its market share? Okay,
No.
Okay. So £20 Tesla and £20 McDonald's. Monty, you need to lose one of your companies. So you have Apple, Disney, Google, Berkshire Hathaway.
Starbucks.
Yeah, do you know what? I'd go with that because there's... Why are you going with that?
I don't really know.
Well, Starbucks also had first mover advantage. They're one of the first popular brands to come out as a coffee shop, all on coffee. Now
Now
you
it's
get...
all about Costa.
Now, Costa, you've got, what are the other ones? There's loads around, isn't there? You got Mark Spencer, you got their own...
Random cafes are being opened.
You got independents breaking up. So, okay, so Monty, £20 into what companies? Remember, Apple pay dividends, Disney do, I don't know, Philip Morris, I don't know, Berkshire Hathaway. So anyway, pick one of those.
I want to put one into Disney Plus.
Disney Plus or Disney? Do you mean you want to buy a show on Disney Plus?
No.
Monty wants to buy
So Disney, yeah? Disney, yeah?
Yeah.
£20 in Disney and £20 in what?
Philip Morris, because it's doing quite good.
Well, they call Philip Morris, right, is a cigarette company.
Monty's going to be a druggie.
They call Philip Morris anti-recessionary. You know, when you have a recession, when the economy slows down and people go to work, they say people will always buy cigarettes. Why will they still buy cigarettes even when the economy's down?
They're addicted.
Exactly. So some people say it's a good play. So
Monty's addicted to Philip Morris, apparently, so he's really going to be a
Can't hear you too far off the mic, sorry, Fred.
Monty's addicted to Philip Morris, so he's probably going to be a druggie.
Okay, that's a good way to end. Thanks for that. And, boys, so you can hold these for the rest of your lives, right? And by the time, if you do this every month until you're 50, and I'm, 122, right?
You'll probably be dead.
Thanks. Then you'll have a lot of money invested in these. You'll have a lot of money invested in these. You think, wow.
You might be 122.
No, you're right, I'm 125.
No.
How old are you then? 12?
Yeah, and I forgot about
38 years.
I forgot about Monty's age, right? You calm down.
38 years.
You're 51.
Oh, well, my age then, 51 plus 38. What is that? First one to answer gets an extra 10 bonus.
Will I get my phone back?
39. No,
39?
89.
What is it?
Will I get my phone back?
Well, you lost the competition, Monty won.
89.
You know, the right question.
Wait, how much do I get?
51 plus 38.
89.
89, yes. Monty got a £10 bonus to put in which share?
Berkshire Hathaway. No, actually, which stocks are doing good?
No, he's put this on Philip Morris, sir.
Berkshire Hathaway then.
Berkshire Hathaway and Philip Morris.
Apple
and
doing good.
Disney.
Apple doing good.
Yes, very good. Good night. Say good night.
No, I didn't tell you.
Go on then.
Berkshire Hathaway.
Thank you. Fred, rather than just stick your bum in the air, say bye-bye.
Bye.
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 The Share Pickers Podcast with Justin Waite. Content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.